China held steady on interest rates, no increase, even though inflation grew at 5% last month, the fastest since July 2008. With more on China's pledge to fight inflation, we bring in Stephen Green. He is head of research for Greater China at Standard Chartered. He's with us right now on the phone from Shanghai. Stephen, thanks so much for joining us. So consumer prices rose at the fastest rate in more than 2 years. China's top leadership pledging to do more to combat inflation. Why didn't China raise rates this weekend? Is it because it was expected?
Well, maybe. I mean, the central bank in the last few months has made a point of surprising the market. But I think the bigger reason is that the central government thinks that by introducing some price controls, subsidizing low-income households, getting rid of the road fees on moving food around the country, that they can knock the inflation problem on the head using those administrative controls and go easy on demand, go easy on controlling inflation through interest rates.
Stephen, I want to ask you in a few moments how likely that plan is to work from your point of view. But in the meantime, I was looking through the report, and it seems like food prices were a major driver of inflation, up almost 12%. I mean, to what extent is this alarming? We know the average Chinese family spends something like 33% of its salary on food. Poor families spend more.
Yeah, I mean, absolutely. Food is a huge part of China's food basket, and so when food prices move up, that is, in effect, it's inflation. It feels like inflation for many, many households. That said, some folks say this isn't a macro problem. This is just a problem with some harvests and some speculation in the food economy. We disagree with that view. We think that wages go up, people eat more food, better food, more oil, more meat, and in the agricultural sector, supply can't keep up with that demand growth. So you get that sort of imbalance between demand and supply, and we think this is actually signaling broader inflationary problems in the economy. So,
Stephen, obviously, in your view, all the measures that the government is saying it is taking are just plain out not going to work. I mean, what about the flip side, that China's economy is growing so fast, the economy can tolerate inflation as long as it stays at a 4 or 5% level?
Well, what we're getting out of the Central Economic Work meeting that happened over the weekend was that China looks to be ready to raise its CPI target. It's historically been 3%. It looks like next year it will be 4%. So exactly that. The central government thinks they can get away with a little bit more inflation. We worry about that. We think that real inflation is always above the official rate because there are some prices that are not accurately catching. And we worry, as you say, it's low-income folk that get hit with this inflation. So if you raise the target, you're implicitly hitting them harder.
And obviously, you could have the risk of social unrest as well. Stephen, thanks so much. Stephen Green joining us there on the phone from Shanghai. He is with Standard Chartered.